You can get discounted deals in this current market from your desktop right now and move forward in property. It's Cam from Premier Property, and today in this video I'm going to be sharing with you some deep dive analytics. We're going to look at specifics in what's happening with analysis, so that you can understand how much of a discount you should be expecting in the current market, how you can actually work out how much the market is likely to fall, and also how you can achieve success by really working out the figures and the numbers so that you got the right parameters so you feel safe and secure investing in property, knowing what you're buying and knowing how much you should buy it for. So stay with me, we're going to cover all of this in this video. Now, if you're like me, you love analysis, and I really like working with facts. Now, here in front of me, I have this chart, and hopefully you can see this chart here. Just going to show you that. Show this chart. Now, this chart is actually a chart from HomeTrack. So, extremely credible data. Now, we like HomeTrack because many of the valuers that are valuing property right now, typically over 75% of them use HomeTrack as a means, as a tool for getting comparables for valuations. So, many larger organizations use HomeTrack for this. Maybe you have, or maybe you haven't as yet, looked at HomeTrack, so feel free to have a look at that. Now, what I love about HomeTrack is the analysis that it actually gives you, real facts, real figures, real stuff that actually works, and so you can understand and you can anticipate and take your action knowing what to do from using the data, which is what we're doing right now. So this chart, I'm just going to put that in front of the screen right now. What you'll notice here is, as you can see, on the x-axis, you have a number of years, and this is very credible data. Like I say, there's over 20 years of data here, and number of years, right? So all the way, as you can see here, all the way from 2000 to current, right? 2000 to 2019, it's showing all the information and the data here. Now on the y-axis, we can see, right there, you can see it, that this is showing year-on-year percentage increase or decrease of property prices, residential property prices. So this is actually showing, in a very easy way of what is actually happening to the market. It's a very interesting chart. I find this chart very interesting, and I'll explain why I find it very interesting. Now, there's a number of things that we can notice. So let's discuss this together. So first of all, we can see that overall the market, the property market, over a period of 20 years, it seems to always be positive. Now, when we think about it, that's pretty good, isn't it? A really good investment vehicle. We know this to be investing in property, that you can actually invest in property. And look at this. Out of the 19 years of data there, almost 20 years of data, we'll find that there's only literally 1 year that we can see that there was no negative growth. For all the rest of the years, it's always been positive. So that's one thing that we can assess from this chart. Now, the second thing that we can assess from this chart is that it's actually showing us, if you look here very carefully, it's actually showing us one and two property market cycles. So all the way where we have a peak and all the way to when we had the last recession. And we know the next recession is coming up. The data is there. We know that GDP is negative. Government's already saying this right now. The figures are there. So we're anticipating the next quarter to be negative growth. And the chances are the following quarter is also going to be in negative growth. So we're looking at 6 months of negative GDP, a falling GDP, which means that we've got 2 quarters of negative growth in GDP, which means that we are then in a recession, a formal recession. But we already know this, that we're heading towards this. Very exciting times. Not great for the economy, to be fair. Not great what's happening out there right now. But in terms of, if we look at the property investor perspective, a really good time to actually be investing in property right now. And I firmly believe that what we got happening in the property market now is not going to come along for another decade. So we're not going to see this for the next 8 to 10 years. And it really is a time to get excited about property and really use the opportunities that are right in front of you. So what we're doing here, of course, is thinking about discounted deals. Now, like I say, this is the second video I'm covering about discounted deals in a series of 3 videos. Now, in the last video, I discussed the different types of agents, the different types of camps of estate agents, categorizing them. If you haven't watched that video, it's on YouTube. Feel free to look back and you can watch that video if you haven't already. And in the next video, I will be sharing with you specific hacks on how you can actually get discounted deals. Okay, so let's continue with the analysis. So we can assess that there are 1 and 2 market cycles here. Now, this chart gets even more interesting because if we look at this, what we can notice is that we've got the one market cycle here where there is much more growth. And the second market cycle, it follows the same pattern, but if you look at the numbers, I'm just going to put that in front of you like that. If you look at the numbers, you notice that the pattern follows, however, the percentages are smaller, aren't they? You can see that right now. So, what do we assess from this? So here is our Premier Properties calculated assessment from using graphs like this. Now, I like to use graphs like this. I like to have simple information. Now, people say there isn't a crystal ball. They say you can't predict things. But you know what? So far in my property investing career over the last 29 years, looking at things like this, scarily, I tend to get it right. And people say to me, Cam, that's really inspiring and it's quite reassuring, how right we actually get this at Premier Property. So, like I said, it's a calculated estimate. But we can see that very clearly from this, a common sense approach, that we have a large market cycle here. Market cycle happens again, but the percentages are smaller. So if we can assess here that in the last recession, the year-on-year growth, there was a drop of 12.5% from market value. Now, keep this in mind, guys. There will be some people that will be saying there's a market drop of 22%. There will be other people saying market drop of 32%. But the thing is, it really depends upon what they actually invested in or what they are using as a comparable, right? So, for example, one of the things at Premier Property that we don't buy is things like new builds. So we don't buy new builds, but we build new builds, if that makes sense. So, I strongly believe the worst deal that you can buy is something in a new build because the price points are much higher. Now, we can't say they're not overpriced, but that stock is priced higher because it is a new build, right? You know what I'm saying. Also, investments like shared ownership, where you got part rent, part buy schemes, where people really have paid a premium. They've paid more for that property, just not their fault, but just because they want to get onto the property ladder. So, they're not the comparables that we're talking about because, those would be a much larger drop. What we are talking about at Premier Property here is good quality stock, secondary stock as we call it. So, Georgian properties, Victorian properties for sure, properties built in the 1930s, and also new builds that are now over 10 years old, which also fall into the secondary stock category, if you like. So these are the types of properties that we are investing in at Premier Property. And what you'll find with these is that you're going to get the best type of stock at the lowest price possible. So best quality at the lowest price, which is what we do at Premier Property. So this chart, if we come back to this chart here, and we see there's a drop of 12.5%, if you think about it, and there's high percentages here. So higher percentages on the growth, higher percentages on the drop as well. When we look at the second market cycle that we've just gone through and are going through, what we can notice here is, like I mentioned, there are a lower percentage of growth. So my view is, at Premier Property, that the calculated assessment is that any drop here that we're coming up to right now is going to be a smaller drop because the percentages rising have also been smaller. Hope I'm making sense here for you. So, here's a chart from Home Track showing real credible data. So from this, we are assessing that a market drop is going to be lower than the previous market drop on a year-on-year basis. Now, we're thinking about discounts. Now, according to Knight Frank Research right now, they're anticipating a market drop of around 7%. And at Premier Property, what we're doing is, because we are investing in specific niche areas, which I would urge you to do as well. If you're not already, I would urge you to do that. To do this, right? To be invest in specific micro areas, in England and Wales, keeping in mind that Scotland is another country. So investing wherever you want to be investing, making sure you got the right area, which we call the gold mine area. A video that I might do later on. So because we are in these specific hotspots, what you will find is in these areas, depending on the area, what we're finding, which is that the market drop is typically going to be around 5 to 10%, depending on the supply and demand in the area. Because there are areas where there are so many investors investing in that area because they understand that property is great. We all know this, right? We all know that UK property in England and Wales, is a good asset class to be investing in. Whether it's the peak of the market, whether it's the recession, many people know that property is a good quality stock, a solid, safe asset base that you can actually be investing in. So we know this throughout the recessions. Having gone through the last, 3 recessions in my lifetime, I've always noticed that even when there's a recession, people are pretty positive about the sales of property. The vendors, still understand that the area is good. They still understand that the property can rent. They still understand that there's a demand for the property. Even in deep recessions is what I've found. So thinking about this, I don't want to be all really positive and optimistic all the time. But you know what? To be fair, practically, there's a lot to be positive and optimistic about. Just by assessing really good, credible charts like this, like home track, credible data, which we can very simply assess, like we're doing right now together. And you find that if you're looking to hedge the market, which is a real solution, you can absolutely do this. So whether you take the 12.5% discount to be conservative, so you can fast track, or whether, like us, you're discussing a 5 to 10% discount that might happen in the property market. Well, all you got to do, very simply, is literally hedge the property market, and that's it. That's simply it, to make sure you safeguard what you're doing, exactly what we're doing at Premier Property. So if we know that there's going to be a drop of 5 to 10% from current market value, then all we got to do is hedge the market by getting a bigger discount of that. So think about the type of discount percentage that you would like, and just take a moment and just write it down. I'll give you a moment. Just write that down right now for yourselves. Now, some of my mentees, they say, Cam, we want a 15% discount. Some of them say 20%, some say 30%. I'm a developer myself, and some of my budding developers, my good friends, they don't look at anything less than a 50% discount. Yeah. So you can decide, really on what discount suits you and fits you for the type of property and the strategy that you're working with. It's not one size fits all. It's specific to you, so you can decide that. But the clarity that you're getting from this video, I hope for you, is that all you got to do, I'll say it one more time, is hedge the market and think about working at only purchasing, only buying, buying good quality stock, working with good quality stock, or sourcing good quality stock, whichever way you're doing this, buying stock at a discount, absolutely getting it at a discount to the numbers that you've confirmed and that you're happy with. Now at Premier Property, we buy good deals, we buy very good deals, and we buy outstanding deals. And the discounts tend to be anything between 20 to 50% plus. So, really good property deals. And of course, you can do this. I train people on this, this, and I'll be covering, much more of this in our videos. So, credible data, very exciting times. And I'm hoping you're enjoying this video. Remember, this is part 2. So feel free to click on the subscribe button, which is just below this video. You know where it is. Just click on it if you haven't already. And that'll make sure that you get the next current video that comes up. So that'll be live there for you. And I will continue to share with you. So in the third video, I'll be sharing with you specific hacks that you can use with estate agents to what you say, how you say it, to get these discounted deals that we're discussing today. Very exciting times. I hope you're keeping safe. Hope you're keeping connected. It's Cam Devady helping you to move forward in your property investing career. I'll see you soon.